All right. Today is Sunday, November 21st. This is a recap for the stock market activities last week and an outlook for the week to come. Are you starting to feel it, huh? The love in the air. Well, neither do I, but I hope you got some good plans this holiday season. In all honesty, though, regardless of how good your plans are, they're not going to be as good as Ben Affleck's, who's going to spend the holidays with both J-Lo and JG. Whoops. Did we get drunk last night and have a threesome? My bad. That was a mistake. And, can we do it again, please? Anyways, my plan, personally, this holiday season is to get blasted higher. Higher than the NASDAQ on options manipulation. So while you're stampeding to save $50 on a piece of crap made in China on Black Friday, I'll be at the garden store. And I have to say it that way because our big tech oligarchs, they don't like the W word, or the M word, or the C word for that matter, or even the hash word. Although I'm not going to get as blasted as Jim Cramer, who on Friday said, the market is down too much, and it's a great opportunity to buy. Just an FYI, the market is at all-time highs, which also happened to be the state of Jim Cramer when he issued the statement. I'm also not planning to get baked as much as Mama Kathy, aka Tesla witch Kathy Wood, did last week when she said, as long as we don't fall in a recession, we are in a bull market. Wow. Wow. I didn't know that. I had no clue. Thanks for the enlightenment, Mama Kathy. And I also don't intend on getting as high as the writer from MarketWatch who wrote this. Brazil's Amazon lost 13,235 square kilometers of rainforest in a year, the most since 2026. In other news, dickhead Ken Griffin beat up a bunch of tulip investors by outbidding them to buy the first copy of the U.S. Constitution. All of a sudden, these billionaires who were bitching and whining about paying taxes found a spare $43 million somewhere to spend on probably a fake Chinese copy of the Constitution, which he will probably jerk off to with his other billionaire buddies in parties. The good news for tulip investors who lost the bidding war is that Mr. Griffin is also selling the U.S. Constitution copy as an NFT, where tulip investors deem it to be more valuable. I just wish Griffin beat Bill Gates in this bidding war because Mr. Gates leaves no enemies behind, right, Bill?
Well, he's dead, so in general, you always have to be careful.
And lastly, in our news updates, this happened in my beloved city of San Diego, especially in Carlsbad, which is a decent place to live unless your name is Carl, because everyone will call you bad. An armored vehicle in the highway near Carlsbad was full of cash, and then accidentally, of course, opened one of its doors, sending cash flying all over the highway. And of course, the geniuses stopped by to collect the cash, assuming that they won the lotto. And just a piece of advice, if you're gonna commit crimes, that's okay, but you don't want to take selfies while doing so. And you certainly don't want to take videos of you jumping up and down like an idiot while committing crimes.
The most insane thing I've ever seen. Someone drop money all over the freeway.
A wild scene on the 5 freeway in Carlsbad today after the door popped open on an armored truck. Wow. Bags filled with a large sum of money hit the pavement, the bills flying everywhere. Traffic came to a standstill as people stopped and scooped up all that cash. The CHP warning that those who took the money need to turn it in immediately. Think that'll happen? Anybody who tries to keep it could face criminal charges if they can catch it.
And of course, it did not take long for the cops to start arresting folks. And per usual, they got the Mexican chick and the black dude first. The white folks, they will get an invitation in the mail. Kindly return the money that you stole to the police at the time of your convenience. And of course, the cops will line up their pockets with some of that cash. Why not? Hey, armored vehicle, do you say you lost $100,000? Well, we found 30. I think that's good enough, right? And honestly, next time, when you see cash that doesn't belong to you flying all over the place, just keep driving. You see, Papa Jerome created this scam for you. He steals trillions from the taxpayer and the next generation, Generation Z, who are dumb to begin with, so who cares? And he uses that cash to prop up stocks higher. So all of what you have to do is YOLO some stocks, better yet, YOLO some random call options out of the money with weekly expiration specifically. The worse the financials for the company, the better. No revenues, no profits. Perfect. These are exactly the companies you want to be in. And boom, you're rich. And you know what? It is legal. No cops are going to come after you. And this is what the rich have been doing for years, baby. Anyways, I got a good one for you tonight, and we haven't even started yet. Here it is. In focus tonight, the big choice. It comes down to Jerome Powell, aka Papa Jerome, aka Mr. Dangerous, aka Criminal Powell, aka the delusional madman, aka the psychopath of the century, versus Lael Brainard, aka Governor Braindead. Just one nickname for now. If she makes it, then we'll find some more. You see, all eyes are on who will become the next Fed chair. Will it be criminal Jerome Powell, or will it be criminal Jerome Powell with a long hair and a vagina? Because if you thought Powell is bad, wait till you hear Governor Braindead, who's basically Powell on steroids. And this is perhaps one of the most watched events in market history. And the reason is inflation, which is threatening the Democrats with extinction in 2022, as voters start to blame the Biden administration for this inflation. Of course, viewers of this channel already know that inflation is always a monetary phenomenon, and the best play for the Biden administration is to blame Jerome Powell, a Republican by the way, for this inflation and replace him with someone who will tighten the flow of cocaine from the Federal Reserve to the market gradually in order to control inflation. The problem is, with this approach, of course, is the fact that it will crash the stock market and would upset the donor class and perhaps drag the economy into a recession because the entire economy is at the behest and the mercy of the stock market. This is of course done by design to ensure that Wall Street wins, and when it loses, it also wins because it has to be bailed out to save the economy, and you can thank your beloved leaders for that. The market is also clearly favoring Powell, so choosing anything but renewing his tyrannic tenure would be suicidal. Likewise, extending his tenure is also a suicide recipe for the Biden administration, and the reason is giving Powell a few more years will ensure that inflation will surge out of whack due to Powell's reckless policies and aloof approach to economic facts. Hence, Biden is stuck between a rock and a hard place.
Come on, man.
We were supposed to receive the decision on Friday, since Biden said the decision will come out in 4 days, on Monday. Well, 4 days already passed. And crickets, nothing, no news at all. And then we received an update on Friday that it will be next week instead, meaning this upcoming week. Okay, while we wait, let's see who is in camp delusional madman Powell and who's in the camp of Braindead. Supporters of Braindead are globalists who are interested in the Fed being more engaged in the globalist agenda by financing climate change initiatives, racial equity initiatives, and gender stuff. Which, of course, we know this is not the job of the Fed. But this is the slim difference between Powell and Brainard. They also believe, ironically of course, that Braindead will fix wealth inequality in this country by printing more fake money to prop up assets of the wealthy, and hence creating more wealth inequality. You see? More wealth inequality equals less wealth inequality. We're smart, right? Even Mohammed Al-Arian endorsed the governor. What happened to inflation concerns, Mohammed? You think Braindead will tighten the flow of coke? Think again. So-called progressives are also endorsing Governor Brainard against Powell. Chiefly Elizabeth Warren, who called Powell a dangerous man. But she's not alone. She's joined by 2 senators, Markley and Whitehouse. Why, you might ask? You guessed it, climate change. I guess the solution to the climate crisis and the biblical drought that we're having right now can be solved by making it rain. And who is in delusional madman Powell camp? Well, Republicans and so-called capitalists, and so-called fiscal conservatives. What a joke. Including Senator Toomey, who's planning to oppose the nomination of Governor Brainard. Powell's allies also include Senator Manchin, who 3 days ago was bitching about inflation. But after meeting with Powell and mainly his donors, he decided to endorse Powell, surprise, surprise, and pressure on Powell is immense right now, as inflation surges out of whack, and Powell is accused of rolling the dice on the economy and the future of this country as a whole. Even hedgies, the likes of Bill Ackman, are now warning of a dangerous bubble waiting to burst in this economy. According to Powell's own 5 benchmarks to raise interest rates, they are now flashing amber, which also happens to be the name of a girl who gave me gonorrhea back in college. But anyways, these 5 benchmarks are flashing amber, according to Bloomberg. Number 1. Are inflation pressures broad-based? Powell says if they are, we're going to start to raise interest rates and perhaps tighten a little more. Well, in August, Powell said the spike in inflation up until that point was largely the result of price rises in a narrow group of goods and services directly affected by the pandemic. That is no longer the case. You hear that, Mr. Powell? Matter of fact, besides energy, gasoline, and cars, which seems to be in everybody's mind, annual price increases are now broad-based. Whether we're talking about meats, eggs, milk, tobacco, electricity, car maintenance, dining out, hospital services, housing, and a lot more, all surging higher. What about number 2? Also in the toilet, because are price rises moderating in those goods and services that have experienced the biggest run-ups? While there were some signs that was happening a few months ago, it is no longer clear-cut. Yes, used car price inflation has come down a lot from its 45.2% high in June, though it is still running in excess of 25%. Annual price rises for durable goods in general, though, clocked in at 7.3% in September, the biggest increase since 1981 that has been fueled by supply chain snafus that seem unlikely to go away anytime soon, and strong demand from consumers flush with cash from successive fiscal packages. I wonder where the fiscal packages come from. But as you can see, durable good prices, have been in deflation since 1995. And this is the first time since then we're seeing durable goods price inflation. Do you hear that, Mr. Powell? Of course not. Number 3, what is happening to wages? Powell told the Jackson Hole conference that he saw little evidence of wage increases that might threaten excessive inflation. Mr. Powell also indicated that he missed his last eye doctor appointment. Anyhow, worker pay has picked up since then as employees have taken advantage of plentiful job openings to quit in record numbers in search of a better opportunity. We believe that the U.S. is entering the tightest labor market conditions since 1950s. Somebody said from Jefferies. As a result, wage pressures are unlikely to ease next year, keeping inflation elevated. And by the way, they're not going to ease anytime. Not next year, not the year after that. Once you give your employees a pay raise, you're not going to take that back. You can fire them, of course, but you have already established the minimum wage. You have already anchored, this is the word that the Fed likes, anchored expectations. And as you can see, wages are surging higher, the highest numbers in the century, of course. You might say, you know what, bro, this is good. Powell is great. For every dollar you get in wages, extra wages, you're paying 2 in inflation costs, your rent went higher, your living expenses are going higher, and oh, by the way, your taxes are also going to go higher, and therefore the dollar that you're going to get extra in wages, that's actually gone. And now you owe the government a dollar, just so you understand. What about number 4? What is happening to longer-term inflation expectations? Fed policymakers pay a lot of attention to what Americans are thinking about prices because officials believe that goes a long way to determining where inflation ends up. If workers and companies are fearful of prices spiraling upward, they will act in ways that will help bring about that inflation. Therefore, the self-fulfilling prophecy. Employees will press for outsized wage gains, Deere, for example, Kellogg, while companies will be quick to jack up prices to cover the rising costs. And then some. And this is, by the way, happening across corporate America. We've heard from earnings, consumer staple companies, Procter & Gamble, Mondelez, Kimberly-Clark, Caterpillar. Pretty much every single company is jacking prices higher beyond covering wage hikes. Inflation expectations among consumers and investors have risen to the highest levels in years as price rises have accelerated, especially for gasoline and other energy products. But so far, at least, that isn't setting off alarm bells at the Fed. Of course it's not, because the Fed is complicit in this crime. The Fed knows what's going on, but the Fed has an agenda, shall we say. And here it is, consumer price expectations are the highest since 2013, according to a survey from the University of Michigan. What about number 5, the last one? Perhaps Powell has some room to wiggle here. Let's see. Are longer-term global forces still pushing down inflation? And this is important, by the way, so pay attention here. Over the past quarter century, inflation has generally been low in the U.S. and across much of the industrial world. Powell has ascribed that to a variety of structural factors, including technological advances and globalization, and argued that they would continue to act as a check on inflation, even after the pandemic is over. Wake up. Wake up. Technology is becoming more inflationary now. Globalization is becoming more inflationary because prices are rising from China. China is no longer a deflation factor. If anything, it is an inflation factor right now. And listen to this. There are signs, though, that some of those forces may be becoming less powerful, at least for now. Import prices, perhaps the best measure of inflationary impulses from abroad, have risen sharply recently. And this is the fastest rise in import prices since 2011. This is the fastest, the sharpest, and the biggest pop in import prices since 2011, a decade ago. Powell's Jackson Hole speech in August provided a clear, comprehensive, and authoritative statement enumerated in 5 pillars of the widest spread team transitory view of inflation that prevailed at that time. And this is according to Lawrence Summers, who tweeted, by the way, I didn't know he tweets. And he says, today all 5 pillars are wobbly at best. So again, what are you waiting for, Mr. Powell? It is now clear that your 5 pillars are gone. Poof. And inflation is clearly winning the battle here. Are you going to do something about it? Of course not. You're going to wait till you're forced to do something about it. And then the outcome will be disastrous. And this leads us to inflation, which turned to be the wild card Democrats failed to anticipate, as even former Obama economists are now sounding the alarm that inflation is getting out of control. And this is, of course, happening on the heels of gas prices skyrocketing in Kim Jong-un Newsom's tyranny that we call California. And most notably, of course, former Clinton Treasury Secretary Larry Summers is also sounding the alarm and now issuing a dire prediction that there is only 15% chance that this economy will work out. Take a listen.
You've been talking about inflation since really early last February on this program and elsewhere. And early on in that process, you said as you looked forward to the Biden economic agenda as they were putting it forward, you saw 3 possibilities. Roughly 1/3 possibility of runaway inflation, 1/3 of a recession because the Fed had to react to that inflation, overreact to it, and 1/3 things would be fine. We actually went to Twitter and asked this week what they thought at this point, and basically what we had is 50% of the people saying they think runaway inflation, 50%, and then the rest were divided roughly evenly between a recession and not much at all. I want to know from you, given we have a lot more data now, where are you on the probabilities?
Unfortunately, I think the probability it's all going to work out well has come way down to perhaps 10 or 15%. I think the probability that, I don't know about runaway inflation, but the probability that we're going to have inflation for a while that's well above the 2% target, I think is about 50 or 55%. And I think the probability that we're going to try to control inflation and it's not going to work out and the economy is going to turn down more than we want, 30 or 35%. So I think the odds have gotten a bit more tilted to the bad outcomes and a bit more tilted to inflation than I thought. I say that because the inflation rates are up. I say that because markets have become more vulnerable. And I say that because the Fed's further behind the curve than I thought it was 10 months ago.
And even corporatist Dr. Jeremy Siegel, aka the Good Professor, is also sounding the alarm.
Victory lap for you, Professor, please, because you saw it, you felt it, you understood it, and what do you see of it now?
It's going to continue. It's not over. We've seen it go above 6% year over year, and I predicted that until this is all over, we're going to get about 25% cumulative inflation. Don't mean 1 year, but over 2 or 3 years, we're going to see the price level really rise by 20 to 25%. So this is not temporary. And by the way, it could get worse unless the Fed gets a handle on money supply growth, because that was the warning I saw early last year. And I do not see enough moderation to give me confidence that it's going to be over soon.
And all of this is reflecting on President Biden's poll numbers, which are dropping like a rock. The worst performance in presidential history as voters start to question the mental capacity of the president, who's, by the way, was not president for a brief moment when absentee Vice President Harris took over. Is this the plan all along? Perhaps. But in the meantime, Biden's approval numbers are sinking, as only 39% approve of his handling of the economy, and even his so-called signature success, the fight against COVID, only 47% of voters now approve of his job, down from over 60% not so long ago.
Come on, man.
When Americans are asked about Biden's accomplishments, the majority, 63%, say, what accomplishments? The president's numbers are sinking among Republicans and Democrats alike.
Come on, man.
And now the majority of both men and women disapprove of the president. What happened to you ladies? You're not into Joe anymore? I mean, he just got People magazine's the senilest man of the year.
Come on, man.
Anyways, the most shocking part of the poll is that the majority of those earning under $75,000 a year are overwhelmingly disapprove of the president. So much for middle-class Joe, huh?
Come on, man.
While 51% of those earning over $75,000 a year approve of the president's performance. No wonder why. We have an economy that heavily favors the highest earners and punishes the poor and the middle class. The president's numbers are sinking across all regions of the country, but most shockingly the West. We're talking about California, Oregon, Washington, all liberal states, by the way, where his disapproval numbers are surging. And now the majority, 55%, disapprove of his performance.
Come on, man.
What is the number one issue in voters' minds across all affiliations? The economy, stupid, meaning inflation, by the way. And what is the solution from Biden? Will shift the blame on oil companies, shift it on price gouging, not the actual source of inflation, by the way, which is the Federal Reserve. You see, we have voices out there mumbling and tumbling, all gibberish, of course, that the inflation that we're seeing right now is due to supply chain issues, or perhaps COVID, the pandemic, or even Biden's policies. Perhaps, but if inflation is due to the fiscal policies from the Biden administration, then how do you explain the fact that inflation is a worldwide phenomenon in various countries, with different economic policies? If inflation is due to supply chain issues or supply issues in general, then how do you explain the fact that gas prices in Saudi Arabia were surging earlier this year until the government capped them in July to prevent further inflation? How do you explain the fact that inflation advanced higher in Saudi Arabia due to fuel price inflation, by the way? Last time I checked, Saudi doesn't have an oil supply issue. If inflation is due to the lack of supply, then how do you explain the hyperinflation in Brazil right now? A country so rich with commodities from oil to ethanol to soybeans to meats to metals to coffee to OJ. Yet prices continue to climb in a shocking fashion, by the way, for the Brazilian consumer. How do you explain that? The answer is inflation is not happening due to specific government policies or supply issues. The truth is, ladies and gentlemen, this inflation is happening due to the biggest outflow of cocaine in history from the Federal Reserve, the biggest surge in money supply in history. What do you think is going to happen? It is the money supply, stupid. Every commodity is dollarized. And when there is so much money floating around, it has to chase certain assets, including stocks, real estate, and commodities. And therefore, we have the highest and most irrational stock market in history. We have the biggest bubble in real estate history, and a massive inflation in commodities, and money continue to chase prices higher and higher and higher to hedge against inflation, but also contributing to it. Thus, when the U.S. sneezes, the whole world catches AIDS. The source, and the only source, by the way, of inflation right now that's happening across the globe is the Federal Reserve. Always. But do you think your beloved media will teach you any of this? Of course not. Your beloved propagandists, take for example Joy Reid from MSNBC, who channeled her inner Stephanie Rule by dismissing inflation as a byproduct of a thriving economy. While she stated plenty of facts, she failed to connect the dots. Take a look.
So Republicans want you to believe the economy isn't doing well. That's terrible. But in reality, unemployment is at its lowest point since before the pandemic began. Prices are higher, which is never good. But Americans are also spending a record amount of money that was pent up during the pandemic, which Economics 101 will tell you drives prices up, aka inflation. And that conflict between how much we want to spend and what we can get into our hands quickly is contributing to how pessimistic many Americans feel about the economy. Consumer confidence is at its lowest level in a decade, according to a University of Michigan survey. And that lack of confidence has translated into a drop in Biden's approval rating, in part because Republicans are seizing on inflation and blaming Joe Biden for it personally, which is a fun twist after Republicans and Trump maxed out the national credit card on tax cuts for the super rich and a partial wall that Mexico was supposed to pay for. I'm joined now by Massachusetts Democratic Senator Elizabeth Warren, member of the Senate Committee on Banking, Housing, and Urban Affairs.
And now she introduces Senator Warren, who we praised on this channel before, multiple times, of course, specifically when she called Jerome Powell a dangerous man, which was imperative because I've been calling him that and a lot more for a while. But when a sitting U.S. Senator concurs with my assessment, at least I'm not crazy, right? But here, in this case, Senator Warren is completely delusional and lying through her teeth.
And here's another thing, because a lot of people are really upset about gas prices. But people weren't driving for a year, and somehow gas prices still went up.
You see, Joy Reid got so close here. Why did oil prices surge higher last year? When the demand was in the toilet, when the economy was shut down, and we had lockdowns all over the place, why did oil prices shot up higher? You and I know the answer. The answer is the coke from the Fed. But Joy and Senator Warren are going to blame it on something different entirely.
There have been some calls to investigate these oil companies because also they don't really like Build Back Better either because it deals with their issues on the environment. But how is it that when people stayed home for a year, suddenly the price of gas went up? Can you explain that?
Yeah. So come on, Joy. We know exactly who the oil companies, what the oil companies pay attention to, what is their number one priority, profits. And so think about it this way. If this were just ordinary inflation, we might see prices go up. But prices at the pump have gone up. Why? Well, let me give you a hint. Chevron, Exxon have doubled their profits.
And of course, Senator Warren blaming the rise in oil prices on Chevron price gouging. Okay, try to explain to the British how Chevron price gouging is responsible for the insane petrol prices they're paying. Perhaps BP, British Petroleum, is also price gouging, and it is all part of a giant, big oil, international conspiracy. Or the reality, the simplest explanation, the true explanation of what's going on. Oil prices are surging higher due to the cocaine, and that's all there is. Anyways, let's move on to the market's coverage and see how this market is doing, starting with the performance on Friday and the week. And here we go. The Dow Industrial Average closing in the red, down by 268.97 points, or a decline of 0.75%. The Nasdaq closing in the green by 63.73 points, or a gain of 0.40%. The S&P 500 closing in the red, down 6.58 points, or a decline of 0.14%. And here is the sector's performance of Friday, leading the pack at number 1, capturing the gold, utilities, and a number 2 for the silver, technology, number 3 for the bronze, cyclicals, and the laggards led by energy, financials, and REITs. And here is the relative performance for the week, leading the pack at number 1, capturing gold, technology, the number 2 for the silver, cyclicals, and a number 3 for the bronze, utilities. The laggards for the week led by energy, materials, and financials. The inflationary trade, no bueno this week, and the reason is the rise of COVID in Europe. COVID is Jerome Powell's, Joe Biden, and market bulls' best ally. What about the advance to decline ratios on Friday? NYSE 29% advancing versus 68% declining. The Nasdaq 34% advancing versus 61% declining. What does that say? The rally in the Nasdaq on Friday and throughout the week, to be honest, was on the back of few names. Few mega cap names, be it Apple, be it Amazon, be it Tesla, be it Nvidia, be it Meta. But the rest of the market was garbage. Moving on to futures. What's going on here? On Friday, oil prices were down big, but natural gas prices continued to advance higher by over 3.5%. And I tell you right here, right now, every dip in oil will be bought. And the reason is, so long as inflation is happening, so long as the Fed's loose money policy continues, every dip in crude oil prices will be bought. And the tactics right now from the administration is psychological only. The release of the strategic reserves, it happened in China, of course, and it's happening in Japan right now. This is all psychological. These strategic reserves are not going to be able to float the market for too long. The power, when it comes to the supply to demand dynamics, is on the hands of OPEC and Russia. OPEC and Russia will not increase supplies because they're concerned about COVID and they see the market oversupplied in 2022. But the main source of inflation in oil prices, again, is the speculation due to inflation hedging and the loose monetary policy. You got to place that money. You got to deploy that money somewhere. If the stock market is overbloated, if REITs, real estate, overbloated, then cash will land in the commodities market, including oil, by the way, because commodities are the best hedge against inflation, the only and true and proven hedge against inflation. And of course, your beloved media are now praising Biden. Prices are going down. Thank you, Joe Biden and China. This is according to CNN, by the way. And even Bloomberg says Biden's oil price approach is working, and he hasn't even acted. Yeah, because all of this is psychological bullshit. If you're going to praise Biden for pulling prices down, were you also blaming him when prices went higher? Of course not, because it doesn't fit the political narrative. Prices went higher due to price gouging, but prices are going down due to Joe Biden. Okay, or you can believe this: oil prices went down due to European COVID concerns. Which one is it? Is it Biden or is it COVID? Or is it the speculation of traders betting that oil will blast higher by 200%. Why? Because there is a lot of loose money floating around. Pick up whatever explanation floats your boat. Doesn't matter to me. But back to commodities. On Friday, lumber prices continue to be concerning here, surging another 5% on Friday alone, and now trading closer to 800. Pretty soon, we're going to see 1,000. What happens then? What happens to the transitory lumber, Mr. Kashkari? But likewise, coffee and cotton prices also advanced higher, while cocoa, OJ, and sugar prices remained flat. Metals prices are down, and I told you the mature guy in the room, gold, is not trusting the decline in the US dollar. Matter of fact, it's calling bullshit. And this is exactly what happened. The dollar popped higher again. And metal prices, gold was right. Gold down, silver down, platinum down, palladium down. But here we go again with the inverse relationship between gold and copper. Gold down, copper trading higher. What about meats? Live and feeder cattle futures closed at the flat line, while lean hogs futures are down again about 2% on Friday. Moving on to grains, the relentless rally in oats prices, no stop inside here, higher and higher and higher. Likewise, wheat prices also higher and higher and higher. Corn prices advancing by a little over half a percentage point on Friday, while rough rice, soybeans, and canola futures pretty much on the flat line. And we had some losses on Friday for soybean meal and soybean oil. Soybean oil lost about 2% on Friday. Moving on to the big casino, the options market. What's going on here? On Friday, the hottest table by far, watch out for this one now, Apple, with over 3 million contracts. About 77% of those are calls. They're buying the 160, 165, now the 170, and I'm seeing the 200 calls being bought. Watch out for Apple here. At number 2, Tesla, the souffle, with about 1.3 million contracts. About 64% of those were calls. At number 3, Lucid Motors, with about 1 million contracts. About 63% of those were calls. Be careful with Lucid here. It moves up and down in double digits. And if you're buying options, calls, or puts with the weekly expiration, you're risking a lot here. Moving on to the unusual activities that took place on the options market on Friday. What's going on here? Starting with the ticker EWZ. This is the Brazilian ETF. They're buying a call spread here. They're buying the 31 and they're selling the 31.5. The expiration date, December 3rd. They paid about 30 cents apiece for the 31 calls, and they received about 20 cents apiece from selling the 31.5 calls. All in all, the entry cost is down to 10 cents apiece. They spent about $500,000 for this trade. What about the trade for the ticker EAT, EAT for Brinker International? This is the owner of Chili's, by the way, and the name is down big. over 40% this year, or top to bottom, I should say. In this case, somebody's buying the bottom. They're calling it by buying the 45 calls for the expiration date December 17th, with the expectations that the name could pop higher by more than 17% by then. They paid about 85 cents apiece to enter this trade, all in all spending about $800,000. At the bottom of the table, what about the IWM for the Russell 2000? They're buying puts here. This is interesting, by the way. The fake breakout in the Russell 2000. They're buying the 185 puts for the expiration date December 31st, New Year Eve, with the expectations that we're going to have fireworks, with the IWM down more than 20.5% by then. They paid about 40 cents apiece to enter this trade, all in all spending about $350,000. What about the trades for the ticker XLNX? This is for Xilinx. This is a calendar put trade. They're buying the January 21st puts and they're selling the December 17 puts, all for the strike price of $190, with the expectations that Xilinx could drop down by more than 14% by the expiration date of January 21st, but not before December 17th. They paid about 14.5 cents apiece for the 190 puts with the expiration date in January, and they received about $7.50 for the expiration date, the puts that they sold, of course, for the expiration date in December. All in all, spending about $3 million for this trade alone. And lastly, what about the trade for the ticker NVDA? Somebody's calling the top here by buying the 330 puts for the expiration date January 21st, with the expectations that the name will drop like a rock. Why? Because they're buying in the money. They paid about 25 cents apiece to enter this trade. All in all, spending about $23 million. So this could be a holder of NVIDIA, perhaps a whale. They want to lock up some of these gains. They don't want to sell the stock because of taxation or whatever, but they want some insurance and participation to the downside, and therefore they're buying the puts in the money, millions of dollars. And this will compensate if the stock goes down all the way till January. And then perhaps they can sell their stock. Who knows? Maybe this is part of the planning. But anyhow, we're moving on to the heat map analysis. What's going on here? This is the heat map for the week, by the way. The performance was awful across the board. Financials down, energy down, healthcare down, industrials down, materials down, defensives down, communication services down, tech down, everything is down. But somehow the ETFs, the indices, closed in the green. The NASDAQ, the QQQ, gained over 1% for the week. How? Well, look at Apple, up over 7% for the week. Tesla up over 10% for the week. Amazon up 4% for the week, more than 4%. Then we have some NVIDIA, sprinkle in Qualcomm, AMD, and you get the rally in the NASDAQ. But is this a solid market? Is this a market in a quote-unquote healthy rally mode? Of course not. And here's the weekly ETF heat map. As you can see, things were so bullish, even the VIX was rallying higher. Even the inverse indices of the Russell 2000, the TZA, was surging higher. Even the inverse index for the Dow, the S-Dow, was also higher. The only market gains were concentrated in chips, you can see it in the SOXL, and technology, and therefore the Qs, the XLK. So once again, is this a healthy market rally? Is this a sustainable market rally? An inclusive market rally? Of course not. Does that mean the stock market collapses next week? Of course not. But it means you gotta be careful here of your assumptions that the market will continue to surge higher and higher and higher. They're gonna run out of time. This is a battle against time, and they're gonna run out of time. And another thing I want you to pay attention to is the year-to-date heat map. These are the gains year-to-date. As you can see, this is the easiest stock market in history. You gotta be a complete imbecile to lose money in this market. You literally have to place your chips anywhere in the roulette table and you're gonna score. The problem is we have losers, year-to-date losers. For example, the Chinese names, Didi, Baba, Pinduoduo, etc. Then we have other names, the likes of PayPal, Roku, Zoom, Activision Blizzard, Zillow, Peloton, Penn National. All of these names are down big. And they continue to go down big. Why? Because we have tax harvesting. Sell you losers. You got to capture those losses to to reduce your tax bill. You have a lot of gains, but you want to reduce the tax bill, and therefore we have tax harvesting and planning that's going on right now. We're doing the same thing, by the way, in our firm. We don't have a lot of losers. The market is easy this year, but we're selling the losers, and therefore everything that is losing year to date or losing recently in the last 3 months, for example, the last 6 months, these names will continue to experience pain, and the reason is people are selling them because they want to book the losses and reduce taxes. So be careful here in buying the dip. Yes, you're going to see pops higher. Technical pops, perhaps the CEO of Activision resigned, and the name pops higher. But be careful and stay away from these names at least till the end of the year. You can buy them again next year if you like them. Perhaps Peloton will be cheaper by then, but buying them now could be dangerous. And of course, when we talk about harvesting losses, you also have to think about the most shorted names. Example, GameStop. We still have a massive short float. We still have hedge funds shorting GameStop, and they're losing right now. They need to book those losses to reduce their taxes. What does that mean? It could, not guaranteed here, but it could pop names like GameStop, heavily shorted names that happen to be trading way higher, and the shorts have no choice whatsoever but to cover because they gotta book those losses. So these names could pop higher. Moving on to charts, starting with the 30-minute chart of the SPY. What's going on here? We had the bull flag formation. The SPY popped higher. It did not recapture the trend line, by the way, but it's still building its way to reclimb that trend line or perhaps create a new trend line. We have to identify a new support, a closer support, and this will be 466. That will be support number 1. Support number 2 will be 462. When we move on to the daily chart for the continuous contract, once again, we don't have the double top scenario, but we're waiting and we're watching for it, the possibility of a double top scenario. For now, the SPY closed the week below 4,711.75, but we don't have a reversal confirmation yet. We don't have a candlestick pattern that confirms any reversal whatsoever. So we are on the watch of a double top, not assuming it's going to be. We know that the momentum indicators are highly extended. But what do we have this upcoming week? We have Thanksgiving. We have the holidays. A low volume trading week. What does that mean? The path of least resistance is higher. And here's a weekly chart for the SPX, the cash index. We are grinding against the upper limit of the channel, the resistance. It is building that energy to pop higher, but this channel is very steep to begin with. So how high can the SPX go? The assumption is it should pull down to recapture the support of the lower band of the channel and then pop higher again. This is how healthy trends work. You have a channel, you have a trend line of support and a trend line of resistance, and you ping pong back and forth, grinding your way higher. Now, when we zoom in to a daily chart for the SPX, same channel again. Are we seeing a bear flag formation? Too early to say, but it certainly looks like it. And the assumption should be, now that the chart touched to the penny, by the way, the upper band of the channel, it should pull down, work its way all the way to the lower band of the channel, the lower end of the channel, and then bounce higher. What we want to watch for is what happens if the chart breaks out, meaning above the upper band. The technical assumption is the market is in a bullish breakout. The problem is we're seeing a lot of false breakouts. Hint, the Russell 2000. And here's a 30-minute chart for the Qs, the NASDAQ. What's going on here? The trend remains intact, unlike the SPY, and the Qs working its way higher. It's closing at all-time highs. What we see right now is a bull flag consolidation, which should pop higher, at least overnight. The support remains down all the way at 397. What about the daily chart for the continuous contract in the NASDAQ? Again, doesn't make sense at all, but it continues to move higher. We have not seen, at least not to my memory, we have not seen the MACD indicator acts like this before. Highly extended, about to cross down, and then it curls back higher again. How far do you want to push this one? It's already overextended. The higher you push it, the riskier it becomes. And the flush down scenario that we've been talking about for a while now becomes more likely by the day as this market, the NASDAQ, continues to pop higher and higher and higher at a whack. Because the last time we saw a rally in the NASDAQ on the backs of options manipulation, that was the SoftBank rally of the summer of 2020. And that came down aggressively. It was a massive flush down, and a lot of NASDAQ names, NASDAQ giants, did not move since then. The likes of Amazon, for example. Now, what about the NDX, the NASDAQ weekly chart? We're moving past the upper band of the channel now. This is the first time this happened. Is it a breakout? Or is it going to be a false breakout, aka a bull trap? This is why we say and we keep the question, is this a bull trap? Because we're about to break out from a major channel. The channel is steep to begin with. And again, how far can you go? When we talk about false breakouts, look no further than the IWM, the Russell 2000, which we thought is moving higher at a consolidation, a breakout. It's been in consolidation box for about a year. All of that energy has to be released up or down. We thought it's going to go higher because this is what the charts told us. And we now know, at least for now, that the breakout was phony, fugazi, because the IWM is down at the support right now of 233. When we look at the weekly chart for the Russell 2000, here comes the breakout. We closed the week below the important number of 2,360. This could be one of the most epic false breakouts in history, at least recent history, because the IWM, to many market participants, is a leading indicator. If the IWM, the Russell 2000, is breaking out higher, a lot of assumptions were that the cyclical trade is back and we're about to see growth in the economy once again. Was it a real breakout? And then COVID in Europe, all of these cases rising in Germany, Netherlands, Austria, was that the cap that reversed the breakout all the way down to the consolidation box once again? That certainly could be the case. You see how complicated it is? It's not easy. It's not a simple answer here. It's extremely complicated. Is it a false breakout, or was it a legitimate breakout and COVID reversed it down? Meaning it was a bull trap, now becomes a bear trap. You see a lot of IWM shorts, put options. They get caught because, the breakout in COVID in Europe is not as contagious or problematic as first thought, for example. We'll see. All I know is this is an interesting one. Because when you dig down, when you investigate, what was the reason behind the dive down in the Russell 2000 and small caps in general? Did it happen on the back of growth or the back of value? Two components of the Russell 2000. We have the chart master in CNBC who's accurate about 20% of the time. He says it is a false breakout. We'll see. But before we assume that, we have to investigate the source behind the false breakout. Was it growth? Or was it value? You have to remember this. The ratio between growth and value for the Russell 1000 right now is at the highest since the 2000 dot-com bubble, the top. And after the crash in 2000, we know that value outperformed growth by a lot. Matter of fact, it was up 60% from the top of 2000 to the top before the 2009 crash, while the Russell 1000 growth was negative throughout all of these years. And of course, after the cocaine started to rescue the market after the crash in 2009, here comes the growth era once again. So my question to you is, well, before we do the question, the decline in the Russell happened because the IWD, the Russell 1000, which is value, that's the one that dived down. The IWF, for example, the growth ETF, actually made a higher high, and the trend remains intact. So the weakness in the Russell is due to the weakness in value. Why is value weak? The reason is COVID. You can see the recent contrast between the IWF and the IWD. The IWF in blue, the IWD, which is value, in orange. So growth in blue, value in orange. Value outperformed growth from February all the way to, let's say, July. And then it was a toss-up. And now we're seeing a breakout. Growth breaking out higher, value diving down. Is there a message here? That's my question to you. Let me know in the comments. Or is this just another false signal? Moving on to the Dixie. What's going on here? I told you be careful of assuming that Tricky Dixie is dead. He plays dead only to pop higher again. But what happened in 96 is an ABC pattern. And now the Dixie is working its way higher. The next target will be 97. It is extended, but so is the NASDAQ. Have you noticed that the NASDAQ and the dollar move hand in hand? And here's gold. What's going on here? The mature guy in the room did not rally on Thursday, even though the dollar was down and yields were down big for the 10-year at least, as if gold knew ahead of time that the dollar is about to pop higher. Always trust the mature guy in the room. We're looking at the three amigos for support right now, and if it bounces higher, then I'm interested. About the chart of the 10-year yield, for now, it's not a death sentence at all because the head and shoulder remains intact. The reverse head and shoulder remains intact. The chart did not close below 1.5% for the week. And for all you know, it could pop higher again. What was the source pressuring yields down at the end of the week last week? The answer is the COVID surge in the EU, and therefore growth expectations are down, and the yields on the long end, the 30, the 20, the 10 are down. Is that about to change? We'll see. We gotta monitor cases for COVID in Europe and see how cases are developing here. Of course, this makes COVID, the Feds, the White House, and market bulls' best ally. More cases, more hospitalization, more fatalities equal higher highs in the market, specifically the NASDAQ. So market bulls should be cheering, COVID, 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 because rates go down, NASDAQ climbs higher. This is the name of the game. And nothing could push yields down right now better than COVID. Here's a weekly chart for the TLT. Again, at the end of the week, the TLT turned green. It did not close above 149, but it could happen this week. And as COVID surges, the TLT will also move higher. You gotta heed this warning though. Be careful of making any assumptions or bidding the house one way or the other. You could say, you know what? COVID is surging. It's just a matter of time before we have another wave here. Another round of shutdowns and restrictions perhaps, and therefore yields will go down. TLT shoots up higher. NASDAQ goes higher, yada, yada, yada. Next thing you know, here comes pills optimism. And then yields pop higher again, TLT goes down, NASDAQ struggles, and the IWM back from the dead. Here comes the rotation of the rotation of the rotation. The VIX 4 hours chart still trading in the green. It was up for the week, by the way. The market was up. So did the VIX. It was up by about 10% or so. The 4 hours chart, the MACD remains green columns in positive territory. What does that mean? It means the assumption for now, VIX is going to move higher, but you cannot assume any longer that the SPY will be down or the NASDAQ will be down. This is the wackadoo market, of course, but it is happening because they're manipulating certain stocks higher via options, and these stocks happen to be extremely large, and they can single-handedly push the indices higher, including the SPY. But this is not sustainable. We've seen this before, folks. Not in 1970s or .com. We've seen it last year, the summer of 2020, the SoftBank rally. The SPY was trading higher hand in hand with the VIX, and we all know how that movie ended. A big correction and a consolidation for a little while. Apple daily chart, what's going on here? It is moving pretty much as expected to the upper band of the channel it has been in since last year. Can it cross the channel? It's not going to happen easily, but look at the volume. The volume is exploding higher due to the options gambling mania. The options volume in Apple moved from about 1 million to 3 million on Friday's close, meaning that the volume has tripled, and therefore they're YOLOing call options with the weekly expiration, of course, for Apple 160, 165, 170, even 200. And they know these are sophisticated firms, of course, not kids in Wall Street bets. They have the tools to know that the market maker is under-allocated in Apple, and if they conduct a gamma squeeze by buying these out-of-the-money call options, the market maker will be forced to buy these shares, pushing the stocks higher. In this case, Apple. They get to make a quick buck right away. But is the rally sustainable? Let's say the squeeze is over and the market maker has to hold these shares. They can hold into them, no problem. But in certain names, let's say Lucid, the market maker is not going to hold on these stocks with absurd valuations. We're talking about Lucid now. They're not going to hold them if there is no use for them. What do I mean by that? If the options market volume recedes, and they're not YOLOing call options out of the money every single week, then the market maker will dump big. And therefore, you're going to see these stocks flushing down big. The moment the volume goes down, run for the hills in these names that ran via gamma squeeze higher recently. There was also a natural remedy to this YOLOing in call options out of the money. It's called the implied volatility. The implied volatility surges higher in, say, Lucid, for example, pushing the premiums out of whack. And it becomes less incentive to buy an option for $3, $4, $5, which means $400, $500 per contract. If you want to double your money quickly, is it more likely for a contract worth $400 to double? Well, it needs to go to 800. It's not easy as, let's say, if you buy contracts for 50 cents a piece, meaning $50 a contract, you can double that easily. And therefore, the gamblers move away from the Lucid table to another one, and the market maker dumps. Boom, the stock crashes. I'm not saying this will happen in a giant stock like Apple because the valuation's not so crazy and the market maker could hold on these stocks. Apple, Amazon, Microsoft, Tesla, the big ones. But the smaller ones, the out-of-whack valuations, watch out. And here's a chart, a daily chart for the Souffle Tesla. Moving higher, and the number we're watching is 1,174.5. The bulls are eyeing a daily closing above that number. which will confirm that Tesla will make higher highs. The bears are looking for a rejection from that point and perhaps a reversal before reaching that number and then breaching 1,000, the important psychological threshold from a daily perspective. And that would be a confirmation that the stock will go down to at least 900, if not all the way to the trend line. Moving on to tulips, BTC. What's going on here? We have some analysts who say that BTC tulips will go down by about 12% more since the support of 58,000 was breached. I don't know. All I know is my number was 55,300. We went down all the way almost to the penny of that number and bounced higher. Is it a false bounce, a dead cat bounce? We'll see. Well, how do you know? Is it a dead cat bounce or not? You have two numbers to watch for. The top of the breakdown candles. We have two of them. That will be target number 1. If that's passed, then we have target number 2 for the upper breakdown candle, the highest number of the breakdown candle. We have two of them. Find out the numbers. I can't do everything for you. And that will be target number 1 and target number 2. If you want to buy after target number 1 is passed, and BTC closing above that number, you're good to go. And then you have target number 2. Now, if you are conservative, on the other hand, you want to wait for both confirmations and then buy. What about AMC? What's going on here from a 30 minutes perspective? Not looking so hot, so we have a bear flag formation for now. We talked about GME, GameStop, and the possibility for short squeeze by the end of the year. It could happen. Could it happen in AMC? Even if it happens, it's going to be a lot smaller than GameStop. And the reason is the short float in AMC is a lot smaller than GME. But regardless, you have the two numbers. You have 42.5, that's your resistance. You have 39, that's your support. For now, we're in purgatory. If any of these numbers are breached, then we have a trade. Lastly, moving on to the economic calendar. What's going on this week? Of course, we have Thanksgiving, but before that, we have a lot of economic activities in the calendar that we have to look forward to. On Monday, we're going to have the Chicago Fed National Activity Index and existing home sales. On Tuesday, we're going to have the manufacturing and services PMIs. And then Wednesday, per usual, we're going to have the initial jobless claims, the weekly jobless claims. On top of that, Wednesday is the most important day by far because we have a lot. We have GDP, we have durable goods, we have personal income, we have disposable income, consumer spending, inflation, home sales, consumer sentiment, and most importantly, the FOMC minutes. And then after that, you lose all your money. But the good news is the turkey is still good, right? Can't upset grandma. You can't explain to grandma, hey, grandma, I lost all your money because Papa Jerome said something in the FOMC minutes and I lost all my crypto gains. She's going to say, yeah, pass the gravy. Anyhow, folks, this is all I got for you for now. But before I go, I want to ask you for a favor. Hit the notification bell because I'm going to have a lot of videos coming out for you. And you might be confused, where is the video? You might want to check on the channel. Click on the channel, refresh the page, and you'll find the videos you're looking for. I'm going to release the earnings reviews. I'm going to release the 13F filings. I'm going to release insider trades. I'm going to release charts to watch and a lot more. So keep an eye on that. But for now, this is all I got for you. Thank you for watching. Thank you for listening. I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.